recording this presentation so that we can provide it on our website for folks that weren't able to be here with us tonight. So I apologize for the formality of the microphone in this setting, but I really appreciate everyone taking the time to come tonight. Our tax system is very complex, and we appreciate you partnering with us to describe it to our residents and our constituents. I would like to take a moment for each of us to introduce ourselves before I introduce the speakers, and I'm standing right in front of Joanne here too, the experts that are here with us tonight. So. I will introduce the esteemed speakers up here this evening. Bruce Munnicky is all the way to my right, and he's been the county assessor here since June of 2001. He also held the position of Woodbury City Assessor and Anoka County Commercial Appraiser and City of Minnetonka Residential Appraiser since 1992. He's currently a member of the International Association of Assessing Officers, that's not easy to say, and Minnesota Association of Assessing Officers, where he served on the Sales Ratio Committee. Our second presenter is Joanne Helm. Joanne Helm is the Taxation Division Manager. She has 27 years of property tax experience, 24 of which at Washington County, and 3 years at another county's assessor's office. In this time at Washington County, she's led us through 2 tax system conversions, and this is her editorial. She swears she will not do another one. So I don't know. I think that was a message to me, but she's active in the computer consortium through which Washington County acquired their tax system software and is past chair of that group. She's also active in the Metro and State Property Tax Group and is recognized as a property tax expert. So with that, thank you again for being here tonight, and we'll start out with the value.
Good evening. I'll try not to yell on the mic here. Thanks for coming. And as Jennifer said, my name's Bruce Munnicky. I've been the county assessor since 2001. And when asked to do this seminar, I eagerly agreed to do it because now I get to point out who the tax person is. Rather than myself, it's Joanne. So, the assessor's office, we work throughout the year to establish the market value and the classification for each property in Washington County as of January 2nd of each year. That's the assessment date. The assessor's office is responsible for overseeing, like I said, the classification and valuation of each parcel in Washington County. Our office is structured, every county office is structured a bit differently. We have local assessors. We have 3 local assessors. They do 8 communities, and we supervise their work. County appraisers, we have 10 residential appraisers, and we have 3 commercial appraisers. They're responsible also for doing all the tax petitions in the county. The county does roughly 80% of the parcels in the county with the appraisers that we have on staff. I was, when I was asked to do this, I, kicked around the idea of how to present, how we establish values. So I kind of came up with the idea of each year we start roughly May 1st with our field inspections, and we do new construction. We work also during that time to establish values, and then we appeal them. So what I'm going to do is we work on appeals, I'm sorry. What I'm going to do is walk through each one of these phases. The first step in our assessment cycle starts roughly May 1st and goes through October 15th. At that point, we have the appraisers, county staff, local staff, have all their information entered into the tax or CAMA system, and all the inspections done at that point. This is called our quintile review. We're required to do 20% each year. Typically, these reviews start after local boards and county boards, or in open books. We ran into a problem a few years ago where we had an appraiser that was out working on the upcoming year when his local boards hadn't even finished, so that caused a bit of confusion to the property owners. So when they're done with their local boards or open books, then that's when they start that process again. We always get the question of who are the property appraisers and what training do they have. All the appraisers involved in the assessment in Washington County are professionals. They're licensed and certified by the State Board of Assessors. The certification that's required is based on, we have different levels. It's based on the years in experience and the training that they've received. University of Minnesota provides training to assessors. The IAAO, the International Association that Jennifer had fun with, they provide coursework. The Minnesota assessors also provide coursework. The Appraisal Institute and Kaplan. During our field reviews, we collect information internally and externally for properties on characteristics that may affect value. We document this information and we enter it into a CAMA system. A CAMA system is a computer-aided mass appraisal system that we use to value residential properties. As I stated, Minnesota state law requires that we review 20% of the properties every 5 years. Each community has a rotating a reappraisal schedule, and we typically post that on the website, so that way property owners can access that and see what part of the community is being reviewed for that particular year.
Does that mean that you have to go into the house every once every 5 years?
Statute claims it's to review it. We attempt to get in. We send out a little postcard to everyone. I hope you all have seen these. Announcing that the appraisers are coming around. And then even on the postcard, we mentioned the Post-it note that we're going to leave on the door. We send these around requesting appointments at the property owner's convenience. And then they leave a tag. We typically, and it's further down, we get in roughly 40% of the properties. So we do attempt to do an interior inspection. And once again, further in the presentation, it's important for us to get out there and talk to property owners. Yeah. That was a good question. I mentioned the blue cards that we send out for the residential reval. Agricultural properties, they get the same type of announcement. With our commercial quintile, we do that by property use. So for example, this past year, for the 2013 assessment, we did all the apartments in the county. So what we do is we send out courtesy letters asking for information, in this case on their rents, their vacancies, their expenses, their complex development type breakdown, their unit breakdown. And we collect this information every year. To be quite honest with you, when we do it, the apartments actually had a nice response, but when we do, say, the industrial properties, we only get maybe 2-3% response from that. We get most of our, for example, industrial information from tax petitions, because that's when there's the sharing of information. Just a couple other times that we review, and throughout this period and in other times of the year, and we'll talk a little more about new construction. And then we also have the property valuation appeals, and then there's times when we need to make inspections just to verify our information. This here, this gives us or it shows you the number of properties that are reviewed each year. You can see that on the bottom, the total, we're looking at roughly 23,000 every year. That includes apartments, commercial industrial reviews, and then the residential / ag quintile reviews. And then I just talked about the percent. You can see it's roughly 40%. So the property appraisers are out discussing our process and values with quite a few people each year. And I think that this is one of the most important things that we do, is go out to the properties, talk to the people. At that time, we answer a lot of questions about process, the appeals, how market value is established. And then, like I said, even just the 40%, I think it's well worth our efforts. The new construction reviews. Once they're done with their quintile reviews, the appraisers typically start on their new construction. And they work the new construction. We finalize our review as of January 1st each year. So they may work, maybe make another run through to see how far along a new house is sometime in January. But they start that in October. And I learned a long time ago, you don't sit on this, because I was doing this when we had that Halloween storm a few years ago. So I try to pass that on to the appraisers, that you want to make sure that you got a good start on it when the weather's good in October. We rely on the local communities to pass on the permits that we go out. We enter those into the CAMA system. We run our reports, and we schedule our reviews based on that. Type of permits, new homes, new commercial, new exempt, new apartments, decks, finished basements, remodels, additions, that sort of thing, things that are adding value. This just gives you an indication of, this is the starts for 2001. This was part of the 2012 assessment. We had 558 starts in 2001, and just to kind of as a reference point, our high in 2004 was 2,568 new homes. So you can see that part of our process is down significantly. Oh, and I put this one in here just to show it. On top of the 23,000 properties that we review as part of the quintile, we also review another 3,000 on top of that. So once again, the property appraisers are out talking to a lot of people during this time of the year. Well, while the field reviews are going on, we start establishing market values for the upcoming assessment. So we started this process in August of 2012 for the January 2nd, 2013 values. We will work on this part of the cycle through January 31st. Our assessment is done as of January 31st. This is actually the fun part. We have the appraisers, they jump on board later in the process once they're done with their new construction. I have some supervisors and some CAMA people that help on this part. Oh, Jennifer forgot to mention that I'm a math major. That's why I think this is the fun part. So odd it is, but. Oh, is this Lynn at work here? Yep. She did this to me. Told her not to do this. Throws me all off. There's 3 approaches to value, and this applies to any type of property: apartment, commercial, industrial, residential. There's a cost approach, and that's estimated depreciation, the depreciated value of the improvements plus the land value. This is used special use properties, such as the former Marathon refinery down in St. Paul Park. We use the cost approach there. Government facilities, churches, and if you have a newer building, you can use this because as the building gets older, it's hard to measure depreciation. So it falls off in use as time goes on. Income approach. This is capitalizing the income stream. And this is used primarily in commercial, industrial, and apartment properties. We have recently started using the income approach with residential properties, as we were getting a lot of the townhomes that were in foreclosure and coming back to us in bank sales. Well, we don't use those sales in establishing our rates. So, and they're selling for $70,000, and they're turning around and they're renting them for $1,000, $1,200 a month. So we just started using the income approach with residential properties. And then the sales comparison approach. Once again, this approach we use on all types of properties. The last 4 or 5 years, there haven't been a lot of commercial, industrial, or apartment sales, so we rely again on the income approach. But the sales comparison approach we use primarily with residential. And we estimate the value of a property by statistically analyzing the sale price of similar properties or sales of groups of properties. And I underline that this is mass appraisal. I'm going to elaborate a little bit on mass appraisal because I think this is a key point, and it's a point that's misunderstood, a concept that's misunderstood. When the appraisers are valuing properties, residential properties, they're using a group of properties to value like properties, because obviously not every property is going to sell. So we use sales information because every property is grouped by grade. So we group all the properties that are graded the same together and measure how they sold, and we apply any adjustments to those properties that are similar. What is mass appraisal and how is it different from fee appraisals? Everybody is familiar with fee appraisals. The purpose of a fee appraisal is for a mortgage refinancing or insurance. The effective date of the fee appraisal or bank appraisal is the date that the appraisal was ordered. Fee appraisals are done one property at a time. There's 3 to 6 properties that are chosen as comparables, and they pretty much, banks pretty much limit the sales period or the period that they draw their sales from 3 to 6 months out. On the other hand, mass appraisal. The purpose of mass appraisal is to determine the value for taxation purposes. Our effective date, as I mentioned earlier, is January 2nd of each year. And we value nearly 90,000 residential properties each year using this methodology. All qualified sales are taken during a 12-month period between October 1st and September 30th. So for the upcoming assessment, the 2013 assessment, the sales we're using to establish value occurred October 1st, 2011 through September 30th, 2012. And then we use statistical analysis to determine equality of the values that we set. So in general, the mass appraisal process values a large group of homes in a defined area by analyzing sales of similar property and applying the results to homes that have not sold. Just another thing to point out too, this is how we establish the market value as of our assessment date. When it comes time during appeals, we put on a different hat and we look at the appeals as a bank appraisal. We'll look at the property on an individual basis just to make sure that we're using current information. This gets us in the right area statistically. The Department of Revenue has certain standards for us, but when it comes time to review values we use at more fee appraisers at that point.
You talk about qualified sales. Can you expand a little what's qualified versus what's a sale that wouldn't be used?
Sure. I mentioned earlier bank sales, foreclosures, relative sales, relocations. Those are not good sales. Those are not included in the sales ratio analysis. Good sales are arm's length transactions between willing buyers and willing sellers. Yes.
Do you bring foreclosures and short sales into that mix?
We do not, most of the time. You know, it's our thought process that the foreclosures and bank sales are already affecting the arm's length transactions, so we don't bring them in. But there are situations in, remember I mentioned earlier about the townhomes? That's where we see neighborhoods that have, you know, they might be 50 units and 20 of them are bank sales. In that case, we need to consider it. Yeah. Yes?
I do get that question many times, especially years ago.
Yeah, oh yeah.
People were very upset because they said, if this is what they are selling for, how can you say that it's not the value?
Yeah.
And part of it is they did not understand the lag time.
Yeah.
But I understand what you are saying, but is it a state law? Where, is this just between Washington County? Is this statewide? What kind of answer am I able to give?
It's statewide.
It's statewide?
Yeah.
And is it in state law, or is it just the practices you play in the county?
I don't know if it's spelled out in state law, but it's just, it's practice. And once again, though, that we do use it in certain situations. But, you know, when you put it in, it's still affecting, even if we don't use them and it's not a neighborhood that has bank sales, it's still affecting the market value. Because if you have a neighborhood, say Colby Lake in Woodbury, first one that comes to my mind, you have just say 250 homes in there, and you might have 3 or 4 that are bank sales. You know, when a good realtor puts a house on the market, they have to look at what's available out there for, you know, as far as what's offered for closures or banks. So it's in the selling price. And, you know, right now, we'll bail you out on that, because now what we're seeing is the bank sales are getting real close to what our assessed value is. So I think we dodged the bullet on that, for now at least. Yeah. So I guess what I would recommend how you respond to that is, if it's in an area where it's the majority, we will look at it. We'll give a neighborhood an adjustment because there's so many of them. Does that help you out any? Okay. You ask the Department of Revenue and you get the, well, it could, maybe, yeah.
I have a question on
Yeah.
the appeal process.
Yes.
How successful are people in getting their market value lowered going through that process?
Can I go through the appeals and then can you,
Oh, sure.
maybe I might answer that? I mean, that's a good question. I just have to, I think it's the next section. I just wanted to, does everybody understand mass appraisal? Like I said, this is the most misconceived part of what we do. I mentioned statistical measures of accuracy. I'm not going to bore you with this. Like I said, it's, once the values are established, we measure this, the sales ratios of each community. Developing values, we look down to neighborhoods again. We'll look at neighborhoods, make sure that the ratio in a neighborhood is satisfactory. If a neighborhood is 80%, of course I should be the other way recently, say it's 115%, we will make an adjustment in that neighborhood to drop the values of all the properties down to a target of 95%. The median ratio of a group of sales helps determine the percent of change needed. How we do that is this year for the 2013 assessment, we're looking at the sales from October 1st, 2011 through September 30th, 2012. And we look at last year's value. And this year we're actually having communities, there'll be several communities that are going to increase in value. So let's just say we have a community where the value is ratio And the ratio, by the way, is the sale price divided by, assessed value divided by the sale price. If we have a community that is at 90%, our target is 95%. And that target is for every community in the county, if it's done by a county appraiser or if it's done by a local appraiser. The target is the same. So in those communities, we would say that community would need roughly a 5% increase overall once we're said and done. If it was 100%, they would need a 5% decrease. Oh, okay, she did that to me again. Right there. I told her not to do that. Another measure of uniformity in this case is the coefficient of dispersion. The county level, over the last 10 years, our coefficient of dispersion has been 6 to 7%. And you can see that the bottom, the goal of a good assessment is a coefficient of 10 to 20. And less than 10 is excellent. And like I said, we've been at 6 or 7 the last 10 years. This is Molly's favorite. Price-related differential. Every year we do an assessment report presentation, and this is Molly's question. So I'm ready for you, Molly. Price-related differential measures the equality between assessment of high and low valued homes. The range is 0.98 to 1.3. We're typically right around 1. We'll have a community here and there that's maybe on either side of it. Regressive. Price-related differential over 1 is considered regressive, which means that the high-valued homes are underassessed. And if it's under 1, that means the high-valued homes are overassessed. But like I said, we don't vary much from 1.
I was just wondering why you don't use the Case-Shiller index as one you're told.
Case-Shiller index, they use bank sales, foreclosure, any lender-mediated sales, they throw it all into the soup. So we don't feel that it's reliable. It's not comparing what we do. We actually use the St. Thomas. You should check St. Thomas out. It's very good. And they actually do a comparison between their study and Case-Shiller. Yeah. You know, when the market's heading down, you might want to use Case-Shiller, but if it starts going back up again, probably then you want to go to the St. Thomas one. So, but you should check out St. Thomas. It's a very good study. But we do get that question a lot. Yeah. But Case-Shiller also has a disclaimer about, you know, want to make sure that you get an appraisal. And, yeah. But the big difference is they use lender-mediated sales in their study. The appeals period. Like I said, our assessment is as of January 2nd each year. On February 1st, we upload our values from our CAMA system to the tax system. We run edits and all that other fun stuff. And in March, mid-March to late March, the valuation notices are sent out. Valuation notices are sent out with the tax statements. I'll discuss what's on the valuation notice. Joanne will end up doing the tax statement. But there's value comparison, prior value, current value. Classification is also listed on there. And another thing of importance is the appeals process is discussed on the back of the form. And there's also information on meetings where they're held, time, local boards, open book, county board. The first step in the appeals process, we encourage property owners to call their appraiser. That information is listed on the valuation notice. A lot of times, they're simple questions. I mean, there's a lot of confusion. The appraisers do a good job of answering questions. If there's a value issue, the appraiser, we recommend that the appraiser go out and talk to the property owner, go visit the site if they haven't just been there. It's also a time for the property owners to share any supporting information that they might have, an appraisal or a market analysis. Just to give you a bit of a call volume, last year the appraisers received 611 calls. Year before, 765 calls, and in 2010 they received 862 calls. So the first step is property owners should call their appraiser. The second step is if they are not satisfied with what occurred with the property appraisers, then they should go to their local board. We have 16 meetings, local board meetings, and we have 4 open book meetings. Does everybody know what a local board meeting is? Does everybody know what an open book meeting is? Oh, really? No? Okay. Local boards, they're formal. You're involved in it. You make the decision. Property owner gives you information as far as their value goes, and you make decisions there. Open book meetings, they're very informal. We have 4 of those. We have 17 communities that are part of the open book process, and we hold them in Stillwater, in Cottage Grove, Woodbury, and Oakdale. Either way, local boards work for some communities, and open books, they work for another. The third step in the process, I don't have a slide for this though, is if you went to your local board and the property owner didn't feel that they got what they wanted, then they would go up to the county board. We have a deadline for applying to the county board each year. That way we can present information to the county board, we can get prepared. And I forgot where I was going. Open book folks, they really don't even need to go to the open book meeting. They can just call the office and get on the agenda. It's not a requirement that you go to the open book, but as far as local board, property owners in those communities, they need to go to their local board first. Now your question. You're looking at it from a success rate for the property owner. I really don't have that information. I know that the volume of calls have gone down. The attendees, for example, the number of calls as part of the 2012 assessment was 611, and the number of attendees at all our meetings was 146. Of that 146, I don't keep track of how many received reductions. Once again, there's the possibility of a reduction, possibility of an increase, or no change. The increases, they turn into no changes. Talk to you next year. Yeah. I mean, there's a few of those, though. What was that?
I'll rescind.
Yeah. I mean, I could probably get you that information if you want. If you could just leave your name and contact number, I could look it up. Yes?
What are the percentages in terms of property values in the county that the assessed values are generally lower between one year and the next? Wouldn't that have usually some impact on who came to the local courts to complain about their assessed values? Haven't they gone down generally in the last several years around the county significantly?
Yeah. I'll be perfectly honest with you, these meetings are about taxes. I mean, everybody's figured it out. It's if you get your value lowered, then your tax will go down. As far as, once again, I'm going to steal a little bit of Joanne's thunder. But our values don't determine tax, they just distribute it. And like I said, we've got that figured out where if I get a lower value, then I'm going to be paying less. So, oops, sorry.
Bruce, I can help a little bit too. There's about 105,000 taxation parcels now in the county.
Yep.
And I think we do keep some stats about how many adjustments to value are made after we send out value notices.
Yep.
And I think that number is something less than 1.5%. And so it's not a great majority. Obviously, the folks who feel comfortable are values that likely aren't going to call us. So the folks that do call us, there's probably a greater likelihood that we might need to make an adjustment because they just looked at it, they said, something doesn't look right, now I'm going to make the phone call and go through the process. So I think there are a fairly large number of folks who started that process that may get some kind of reduction. It may not be to the level they expect or would like to see, but I don't think that means if half the folks that called and getting a reduction, that doesn't mean we got half of the properties in the county valued correctly. It means half the folks that called maybe were warranted an adjustment. So it's frankly, it's a pretty small number of the total properties that never get any kind of adjustment after the valuation is done. And part of that issue is, as Bruce mentioned, the mass appraisal process. And that's part of what this is all about, is you mass appraise and you take care of the issues that are not handled in mass appraisal through this informal appeals process. That if mass appraisal doesn't fit your property for some reason, you've got an avenue to talk with the assessor to get those things handled.
Yeah. And we keep it pretty simple. The burden of proof is on the property owner. And if the property owner has anything that's credible, we're not even going to send them off to you. We don't need you to make that decision. We're going to make that adjustment. There are times when we get information that's not quite so credible. That's when we look at it closer and then we do our own, as far as a bank type appraisal. This is just kind of a nice flow chart that we go through. It shows the 3-step appeal. Option 1, once again, call your appraiser, go to your local meeting. If you're not satisfied, go to your county meeting. And then ultimately, too, you can go to tax court if you're not satisfied. Or you can, a lot of commercial properties, which is good because you really don't want commercial appeals at the local level. It's a complex process, and we prefer, if they're going to share information at the local level, we're looking for 3 years income and expense information. There's typically an appraisal out there that we want shared. They kind of try to bypass that whole process and go right to tax court. And just as we're on the subject of tax petitions, Pay 2012 tax petitions, there was 275 filed. That's down from a high in Pay 10 of 325 petitions. And the majority of those petitions are commercial industrial. Also Pay 2010, the highest value, the total value appealed was $1.5 billion. And we're down to $1.1 billion appealed for Pay 2012. And as far as the success rate for tax petitions, we probably get 25% dismissed, non-payment of taxes. I would say we end up dealing with maybe going on to a second, third setting with 10, 15%. Of the remaining, half are dismissed. They didn't provide us with any information, or we did an appraisal and the value is fine. So, any questions on tax petitions? I just wanted to point out that information regarding, we've got sales lists out here. This is the assessor's website. That's the web address. It's a good source. We keep it updated with sales listings. And we also put together an assessment report that's out there. So this is a good source of information. After the county board is over, values remain the same unless we run into a clerical error or a tax petition that's settled. And at that point, we turn it over to the tax group. Do you want me to take any questions now, or do you want to do it later? Yes?
Could you talk a little bit about agricultural values and how they're established based on the value of land in southern Minnesota? Is that something
Sure.
that seems to be very common?
Yes. Agricultural values. Agricultural values are based on residential sale prices. If a property is on the deferral program known as green acres, they don't pay at a high value. They pay taxable value based on green acre value. What Molly was mentioning is that green acre value, what did the taxable value go up this year? I mean, we get a lot of calls about that, 20% on taxes, yeah. That agricultural value, the low value we call it, is established by the Department of Revenue. They take 5 counties in southwest Minnesota, and they pull the sales from that area because it's deemed to be an area that's not under the influence of residential or commercial development. So they use the sales out of that area. And I think we're going up 20% again this year. We're getting to the point, some places in the county, where the high value and the low value are going to be pretty close. What do you think? They started this probably 3 years ago. Their thought was to give it uniformity throughout the state. They have 100%, well, actually they have a ratio. Each county has a ratio of the full value. Department of Revenue establishes the full value per acre, and they give, like our median is 95%. So we come in at 95% of that median value. And we have such an odd-shaped county that what we've done is we have a median, I think it was $4,500 an acre, that we need to reach. What we've done is we have a south value and we have a north value, because we also need to match up to Chisago County and Anoka County in the north, and then Dakota County in the south. So that's how we've determined to get that ag value established. And like I said, it's going up another, from what I hear, another 20% based on sales of ag parcels out in southwest Minnesota. Yes?
Business property taxes. Touch on that.
I would love to.
Is it based primarily on the value of the structure, or is it also based on the type of business and the income of the business?
You're talking tax or value? Because I'll leave the taxes to Joanne. Yeah. So you want to know?
Value and then taxes.
Okay. The value is based on the income. The income the property's producing, and we capitalize that. I mentioned earlier that we don't have a lot of sales, so the sales approach is not as credible as what we have for income. We gather a lot of income when we go out and review properties. We send out, remember the letter I mentioned, we get 2% back. Then we go out and review the property and we get more information at that time. Tax petition, another good source of information for commercial industrial property. Bottom line, income. Yes?
Once land is platted for development, can it be returned to an ag classification?
Oh.
Because we've had in Baytown, particularly one farmer that farmed the land, had set it up for development. Lot sales have not sold. Part of it, I think, is going pricing kind of index, and then all of a sudden you sell the lot at a high value, but the rest of them don't sell because its price can be as higher than what it should be.
The other developments in Baytown?
Yeah, and then he complained about his land is overassessed.
Yeah.
I'm wondering what you tell him, and also is there an option for some of those people to farm that land again and have it
Classification and green acres are two different things. You're referring to the ag classification. There are platted developments that are still qualify for ag. They have to have 10 acres in production. Yeah. That particular development, there's no ag activity. And as far as how we overcome the annual review, we compare those to the other developments, the values of the other developments in your community, and his values are fine.
So because you don't go by sales price at all in terms of what he's asking, you
Yeah.
only go by what a property sells for.
We'd have to raise his values.
Right.
Yeah. Yeah, and you know, the last few sales that we've received in that area, they haven't been what we call good sales because they're between the developer and a builder. Those usually have some added cost built into it. So what we do in that situation and in others, we'll look at other developments. And other developments are selling 115 to 125. So that's pretty much where the value on the neighborhood you're talking about should be. Yeah. Yep, sure. In his green acres, he wouldn't apply for green acres. He wouldn't qualify for green acres. So, yes?
What about like, your empty commercial properties? I'm assuming many do square footage price or something like that, any hectare, billions have been sending nothing for a while, you have sales ratios or nothing, what would you use for them?
Property of the same use, and we would give it some sort of discounted price. So we would compare it to other businesses in use, and then we would reduce the value after a while. We wouldn't do that initially, because otherwise we'd be up and down. That one's been empty, though, for quite a while, and that building value has been reduced. And that one just sold, too. I don't recall what it sold for. Yeah. We're at our reduced value, we're okay value-wise on it. And the thing is, you have to remember when the sales ratios are low in certain areas, that's going to affect others like them in the same community. So that type of use, yes.
So I understand that, the income based on the commercial property. So if you had two equivalent businesses, one was a very good businessman, made a ton of money, and the other one was not, you would tax that person more on his property?
Value?
Value?
Yeah. Thank you.
Value?
No, that would be business value. Yeah. We don't value the business. The income stream. So we have enough information where you may own a building and you're leasing it out to somebody that's a light manufacturing business. We don't look at the sales, the products sold. We just look at the real estate. So we don't look at the number of burgers sold or number of clothes that are sold. Yeah, yeah. It's what market rates are. Yeah, yeah. I mean, there's a few attorneys out there that would like us to use that for their Kohl's petitions, but depending on which one it is.
Okay. So transitioning now from values to taxes, the first thing I want to emphasize is that property tax is a 2-year cycle. The value that Bruce establishes on January 2nd is used for taxes payable in the following year, and that's because of the timing of all the processes that need to take place. And the second thing to emphasize, and I think Bruce has made this point, is that property tax is ad valorem, meaning according to value. But what value? As Bruce indicated, they finalize the values and turn them over to taxation. The value set by the assessor is referred to as estimated market value. But that's not the value used in calculating property taxes. There are certain property tax programs that provide for exemptions, exclusions, or deferrals of market value that exclude a certain portion of the value from taxation. So excluding the value on some properties has the effect of shifting the tax burden to other properties. So this is the list of programs that provide for a reduction, exclusion, or deferral of value for property tax purposes. We've already talked about some of them. Green Acres, Rural Preserve is a similar program, Open Space, Plat Law exclusion. There's a This Old House exclusion, Disabled Veterans exclusion, a mold damage exclusion, and a homestead exclusion. I'll just give a brief summary of each program. I think we've already talked about Green Acres, where it applies to agricultural property that's facing increasing estimated market values due to non-agricultural influences. So the assessor would establish a lower value for tax purposes, and so the difference would be deferred until, and the property would be taxed at that lower value. The difference would be deferred until such time as the property no longer qualifies for the program. And then at which point there would be a 3-year payback of the difference. Next program is Rural Preserve. That's pretty similar to Green Acres. Really, there were some agricultural law changes a couple years back that created a rural preserve, or a rural vacant land classification. So it's similar to Green Acres. There's also an open space deferral, which again is a deferral similar to Green Acres, but instead of for agricultural property, it's for outdoor recreational open space and parklands. So the assessor again establishes a lower value for tax purposes. The difference with this program is that there's a 7-year payback when the property no longer qualifies. There is a plat law exclusion for land that has been recently platted but not yet improved with a structure. The increased market value due to platting is phased in over 3 years. That the 3-year period is for the metro area. It's a 7-year phase-in period outside of the metro area. There's also a program that was known as This Old House. It's now expired for any new exclusions, but parcels already in the program may continue to receive the exclusion. This program applied to improvements made to certain older homes. Qualifying properties that had improvements that increased the value by more than $5,000 were eligible to have some of the value deferred for up to 10 years. And then after that time period, the value would be phased back in over a period of years. There's also a disabled veterans exclusion. Qualifying disabled veterans can get a value exclusion on their homestead property. Depending on their disability level, 70 to 100% disability that's service-connected are eligible for a $150,000 exclusion, or 100% permanent disability is eligible for a $300,000 exclusion.
That's also extended to the spouse of the veteran who passed away.
That's correct. There is a mold damage exclusion for homestead properties damaged by mold. This is something that the taxpayer has to apply for. It's not something we do automatically. The cost of the repair must be at least $20,000, and upon completion of the work, the county must grant the reduction equal to the cost of repairing the damage. We have a relatively small number of these. And then the largest exclusion that we have is the homestead exclusion. This was formerly a homestead credit, but was converted to a value exclusion for taxes payable in 2012. So it's a sliding scale amount. The exclusion amount decreases as values increase. The exclusion reaches a maximum value of $30,400 on a parcel with a market value of $76,000. It then phases down to zero at a market value of $413,800. So some of the implications of the way this works are, in a market where values are decreasing, it'll cause values to go down even more, because as the value decreases, the exclusion amount increases. And conversely, in an increasing market, it'll cause market value increases to go up faster because the exclusion will decrease as the value increases. And really, this is the same phenomena that we're seeing with the former credit. It was the same sliding scale formula, so really has the same outcomes.
Ms. Jones,
Yes?
if someone finds to qualify for some of these deductions that they've been approved, is there any retroactive relief from the previous year's taxes that they may have paid?
Right. That would fall generally under a tax abatement, and we do have a policy in place to deal with what properties would qualify for an abatement. Generally speaking, there has to be some hardship that would fall into that. I'm trying to think. Homestead is something that we would process a lot of homestead abatements, but for other things, correct. Correct. That's what we would want. Okay. Oops. Not too far. So in order to calculate what we call taxable market value, we would then subtract all of the exclusions from the estimated market value that Bruce established. But even once we get to that point, we still aren't done, because taxable market value isn't the base value used for calculating taxes. It's just a starting point. We would also have to look at classification of the property. And generally, the use of a property determines its classification. Classification provides for different types of property to be taxed at different rates. And the way it works is that the legislature sets a class rate for each property classification. So the class rate would be applied to the taxable market value and result in a tax capacity. So for a parcel, their taxable market value times class rate equals tax capacity. And that is actually the basis for most taxes. Most taxes are based on tax capacity. And this structure allows different types of property to be taxed at different levels and ultimately determines who pays what share of the total property tax bill. So, some examples of class rates on some of the major property classifications. Residential homestead and non-homestead actually both have the same class rates. The first $500,000 of taxable market value is taxed at 1%, and over $500,000 is taxed at 1.25%. If you look at ag homestead land, the first $1.29 million is taxed at half of 1%, and then any value over that would be taxed at 1%. Or non-homestead land is all at 1%. Looking at commercial, industrial, or public utility property, the first $150,000 is taxed at 1.5%, and over $150,000 is taxed at 2%. These percentages, as I said, are set by the legislature, and so they're uniform statewide. So I'm going to walk through the calculation of tax capacity on a residential homestead and a commercial property, both valued at $250,000. On the residential homestead, the homestead exclusion on $250,000 is $14,700. So if you subtract that off, you get a taxable market value of $235,300. That's less than the $500,000 tier, so it all goes at 1%. So multiplying that out, that gives us a tax capacity of $2,353. Now, on the same valued commercial property, there are no exclusions, so the taxable market value remains $250,000. The first $150,000 goes at 1.5%, which is $2,250, and then the remaining $100,000 goes at 2%, which is $2,000. So that gives us a total tax capacity of $4,250. So you can see there that the tax capacity on the same market value, the commercial is almost double. I think it works out to be about 1.8 times larger than the residential tax capacity. And we'll get more into the tax implications of that later on, too. Now, another way that Minnesota builds complexity into the property tax system is with the use of multiple tax bases. As I mentioned, tax capacity is the basis for most taxes, but we also have referendum market value, which is the basis for some referendum levies, such as the county has a land and water legacy program, and then there are school operating levies, not building bonds, but the levies for operating purposes. With market value taxes, it doesn't apply to farmland or cabins. There's a reduced rate on value with a tax capacity rate, class rate of less than 1%. And it does apply to the homestead exclusion value. So in other words, there is no homestead exclusion for market value taxes. They're taxed at the full value on that. And then there's also a state tax base. The state started a state property tax levy in 2002, and it applies to cabins and commercial, industrial, and utility property, with the exception of electric generating machinery does not pay the state tax. So far we've seen for complexity, we have value exclusions that affect certain properties. We have varying percentage of value that is taxed depending on the classification of the property. And we also have different tax bases that apply depending on the classification of the property and the type of tax. So as you can imagine, these all combine to make it pretty difficult to predict or explain tax impacts. The next few slides are mainly provided for your reference. I won't go over them in any detail since we've looked at the major classifications, but what this is it's a list of all the property classes and the corresponding class rates, and then I've indicated what tax bases or types of tax apply to that classification. Generally, you'll see that all classifications will have tax capacity tax. That's kind of the general base. Commercial industrial will also have fiscal disparity tax, which I'll get into more later. Commercial industrial and cabins will have the state tax, and then all except farmland and cabins will have the market value tax. So there's roughly 40 of them, I believe. So once we get to that point, we then calculate tax base values for each parcel in addition to the estimated market value. So for each parcel, we'll look at what are the exclusions or deferrals that a parcel qualifies for, what is the taxable market value, what's the referendum market value, what's the tax capacity, and what's the portion of tax capacity that qualifies for the state tax. We then add up the values of the individual parcels in each taxing authority to get to the total tax base value for each taxing district. And as I mentioned previously, taxes are ad valorem according to value. So an individual parcel's tax liability is based on what percentage the parcel's value is of the taxing authority total. And we do this by calculating a tax rate that's applied to the value amount. Now, before I get into the tax rate process, I want to briefly mention a couple of special programs that use a portion of tax capacity for other purposes. And that is tax increment financing districts, fiscal disparities, and power line credit. We have to adjust tax base values for each taxing authority for these three programs. Since they use a portion of the tax capacity for other purposes, that value then isn't available to the county, city or town, or school district to fund local levies. So we have to reduce the tax capacity value that those programs are using when we determine the value used to calculate the tax rate. So just a little information on each program. You may have heard of tax increment financing or TIF districts. TIF is an economic development tool primarily used by cities. And the way it works is when a city creates a district, the base value at the time of the properties in the district is frozen. And in subsequent years, as the value increases, the TIF district captures the increase in value over the base year and the tax generated by that value increase. So since that value is used to fund project development costs in the TIF district, it's not available for county, city, and school levies, and so that value is subtracted when we determine the value used to calculate the tax rate. With fiscal disparities, that is a tax-based sharing program enacted in the metro area in 1971. And the way it works is each taxing authority shares 40% of commercial industrial growth since 1971 with a metro-wide pool. That value in the pool is then redistributed on a formula based on relative fiscal capacity, which basically means market value per capita. And then a portion of each tax authority's levy is funded by the pool and reduces the levy to local taxpayers. So really what it is it's a redistribution of a portion of the tax base value. You put value into the pool and then receive distributed value back from the pool. So as you can imagine, that creates situations where some people gain value through this process, some people, or I should say jurisdictions, lose value through the process. Just as a note, countywide, we will be a net contributor for the first time in 2013, where the county as a whole will receive less than we are putting into the pool. And so we will actually be sending a check to the fiscal disparities pool. Ramsey and Anoka County are the biggest gainers through the process. That's where the value goes, generally speaking. So again, similar to TIF, the portion of value contributed to the pool, which is then redistributed through that other process, isn't available to fund local levies, and so we have to subtract it when calculating the tax base value. And then just one more note on fiscal disparities specific to Washington County is that in tax rate calculation, or in tax calculation, there's a fiscal disparity tax rate that's uniform across all metro counties. And because we have fairly low tax rates in Washington County, that fiscal disparity tax rate is quite a bit higher than local rates. So that tends to exacerbate tax increases on commercial property. Yes?
Can you explain why there's that 2-year lag with that fiscal disparities where, like the improvements that we got at Excel this year will show in the numbers of fiscal disparities next year? Why is that?
It's actually the formula for the calculation is it's 40% of the increase between the prior year and the year before that. And so that's why you end up having a lag. And again, it's because of all the processes that have to take place in between, and calculations in between there. The third thing we have to adjust the tax base value for is the power line credit. It doesn't affect a lot of parcels in the county. It affects specific power lines that are greater than 200 kilovolts built after July 1st of 1974. Basically, in Washington County, it's a line that comes down from Canada, and in Washington County, I think it goes through Scandia, Hugo, Grant, and it actually ends in Lake Elmo, kind of just east of 694 or 36 there it crosses over. Parcels crossed by that line are eligible to receive a power line credit. And so 10% of the value of the power line is excluded from the tax base, and instead the tax generated by that excluded value then goes to reduce taxes on those parcels based on the number of feet on each parcel.
So, that doesn't necessarily come off of the entire tax property that comes off the area that the line actually covers. So just
Right. It would come, that value, 10% of the value of the power line in the area where the line is located is what would be excluded. So those three value amounts then are subtracted from the total tax capacity to get to our tax base value. So then the next step in the property tax cycle would be to calculate tax rates. Now, before I get into the calculation, an important concept with property taxes is that property taxes are different from income taxes where rates are set but the total amount raised is unknown. With property taxes, the amount to raise is determined and a rate is calculated that raises exactly that amount, no more. So that actually makes property taxes a stable revenue source because there are no deficits or windfalls. So the first step in the tax rate calculation process is actually the local budgeting phase. Taxing districts determine the amount of money they need to fund the services they provide, and then subtract what will be funded by non-property tax revenue or state aids to determine what portion will need to be funded by the taxpayers. That's called the levy. They certify that levy amount to the county, and then at the county, we'll subtract the portion of the levy that will be funded from the fiscal disparity pool that we talked about a little bit ago to come up with a local levy. And we then calculate a tax rate for each taxing district. So the local levy divided by the tax base value equals the tax rate.
Are we guaranteed what we levy?
Not necessarily, because there may be delinquencies. They may eventually get paid, but eventually certain parcels may go tax forfeit and not pay. The gentleman asked about abatements. There are possibilities where we may abate taxes, or folks may go to tax court to get values and therefore taxes reduced. So each taxing authority, as part of the levy process, would need to look at their history of what amount they actually collect.
Is that something you could provide us, so we could get an average over the past, say, 5 years?
Yes, we actually have some reports that show levy amounts and then collections related to that. So yes, we can. Okay. Each tax base has a different tax rate that applies, so we would calculate both tax capacity and market value based rates. And then as far as the state tax rate, that's something that all counties submit their values to the state, and actually the State Department of Revenue calculates the state tax rate and certifies that to each county. And actually it's two different rates. A different rate applies between cabins and commercial property. So let's walk through a simple example of a tax rate calculation. Assume a taxing authority with the given budget and value information. So a budget of $500,000, state aid of $50,000, fiscal disparities levy of $75,000, and a total tax capacity of $1 million. The first step would be the city would certify a levy of $500,000 minus their state aid or other resources of $50,000. So that would be a certified levy of $450,000. The second step is that the county would calculate the local levy, which would be the certified levy minus the fiscal disparities portion. So $450,000 minus $75,000 would be $375,000 would need to come from the local taxpayers. Then we would calculate a tax rate by taking the local levy divided by the tax capacity value of the district. So $375,000 divided by $1 million would give us a tax rate of 37.5%. So when we multiply that 37.5% by the tax capacity of each parcel, which in total would add up to $1 million, we would raise $375,000 in tax based on the tax capacity value of each parcel.
That 1% or 1.25%, is that how that figure comes in?
Correct. It would be the tax capacity value like we calculated on that residential parcel or the commercial parcel. Yes. So we calculate tax rates separately for each taxing district. We have county, cities, towns, schools, state, metro special taxing districts, other special taxing districts. And the rate that applies to the parcel is the total of all of the rates of all of the tax authorities that it is located within. And sometimes in our terminology, we call that a unique taxing area. And that's, I guess, an important concept because that's how we report the tax rates. So there's a simple example slide. Basically, we have the metro area, and within that, we have a county. Within that, we have a school district, and within or overlapping that, we have a city, and then overlapping that, we may have a watershed district. And in the area where all of those tax authorities intersect, where all property is located in the same district, so the shaded area there on the slide, it has the same set of tax rates that apply. That's what we refer to as a unique taxing area. So if you imagine the county map, it's like a crazy quilt of areas that would have all different tax rates that would apply. So once we have tax rates, we can then calculate taxes on each parcel of property. So the formula for that is we would calculate a tax capacity tax by taking the tax capacity of each parcel multiplied by the tax capacity rate. On commercial industrial property, we would also calculate a fiscal disparity tax by calculating a fiscal disparity portion of the tax capacity multiplied by the fiscal disparity tax rate. We would calculate a market value tax by taking the market value of the property times the market value rate, with the exception of farmland and cabins wouldn't have that tax. And on cabins and commercial industrial property, we would calculate a state tax by multiplying the state tax capacity times the state rate. The total tax due for a parcel then would be the tax capacity tax plus the fiscal disparity tax plus the market value tax plus the state tax, and then less any credits that a parcel may qualify for. And in Washington County, the credits we have are the power line credit, which I referred to earlier, and then there's an ag preserve credit, an ag homestead credit that would apply to some agricultural properties. So, I know there was a question on commercial property taxes. I thought it would be helpful to walk through an example of a residential homestead tax calculation, and then I've got a commercial tax calculation too on the same value property, so you can kind of see the differences between them. So on a residential homestead property, and I use the rates for Woodbury in this example. This is an actual parcel for 2013 taxes. Let's assume an estimated market value of $250,000. The first step would be to calculate the homestead exclusion. So the first $76,000 would be at 40%, which would be $30,400, and then the remaining value would be $174,000 multiplied by 9%. So that would reduce the exclusion by $15,660. Leaving an exclusion of $14,740. We would then calculate taxable market value by taking $250,000 minus $14,740 to get a taxable market value of $235,300. I'm rounding to the nearest $100 here. The next step would be to calculate tax capacity. $235,300 multiplied by the 1% rate, since it's all under $500,000, gives us a tax capacity of $2,353. We would then calculate the tax capacity tax by multiplying that times the tax rate of 121.192% to get a tax of $2,851.65. We would then calculate the market value tax. And here we're not taking the taxable market value, we're taking the full market value of $250,000 times 0.24789% to get a tax of market value tax of $619.72. And then the total tax, adding the two tax amounts together, is $3,471.37. Now, if we calculate the tax on the same value commercial industrial property, estimated market value and taxable market value are going to be the same because there are no exclusions that on the commercial property. So the next step would be to calculate the tax capacity, the first $150,000 at 1.5% and the remaining $100,000 at 2%. So that gives us a tax capacity of $4,250. It's commercial industrial, so we calculate a portion of that tax capacity, and this percentage varies by city. This is the percentage that will be taxed at the fiscal disparity tax rate. So 4,250 times 39.235% gives us 1,668. Then we would calculate the remaining portion of tax capacity by subtracting that from 4,250. So 2,582 would be taxed at the local rate. So we would multiply that times the rate of 121.192, which is the same rate we used previously, on the residential property. So that gives us a tax capacity tax of $3,129.17. We would next calculate the market value tax, again, $250,000 multiplied by the tax rate, and that gives us $619.72. And if you remember back on the previous slide, the market value tax on the residential property was the same amount. We would then calculate the fiscal disparity tax by taking the 1,668 times the rate of 153.491 to get fiscal disparity tax of $2,560.23. And then we would calculate the state tax, which is $4,250 multiplied by 53%. So the tax amount is $2,252.50. Now, when we add all those tax amounts together, we get a total tax of $8,561.62, which is more than double the homestead tax on the same value. I think it's roughly 2.4 times. So a couple of the reasons for that is, in addition to the higher class rates, percentage of market value that's taxed, the fiscal disparity tax rate is higher on a portion of the value. You've got 153% compared to 121% local rate. And then you also have the imposition of that $2,200 state tax.
Would that change at all? Let's say if the state legislature got rid of the state tax, how would that change the overall formula?
If the state tax was totally eliminated, you would eliminate the $2,252.50.
Wouldn't change any other part of the
No. Not without changing class rates or some other aspect of the calculation. Yes?
Kind of go back to homestead. If homestead is valued over that $414,300, what would keep a person from retaining ownership of the property but simply moving to a low income tax state? How would that affect the taxation on a property like that?
I'm not quite sure I'm understanding the question.
Some of them in my community will establish their residence in Texas, but retain their property here. It would not affect that, would it?
Oh, are you saying just not homestead the property?
No. Their state of residence would change. Their property here in Minnesota would not change. What would keep somebody from doing that? Why not go to a low income tax state and retain the property here? Would it affect the property that's over $414,300 at all?
Yeah, do they have to be Minnesota resident to homestead? I can't recall that. Yeah, so then they would not, they wouldn't qualify for homestead. So they would be taxed the same, I guess. What they would want to consider is there can be property tax refund programs or things like that that may only apply to homestead property. So, they'd need to consider those factors in making that decision. But once you get over the $413,800, the tax calculation would be the same for homestead and non-homestead. So, it really depends on a person's situation. There are factors they'd have to consider there.
There's a lot of people doing it.
Mm-hmm.
I don't see any difference in how it would be treated.
You're saying you don't qualify for the homestead credit unless they're a resident, right?
Right.
There's some people that do that with their cattle here in the state. And they're above
Oh.
415,000. So they won't spend their cattle. I've heard that numerous times.
Okay. Well, so far I've talked about the steps in the process and what we do, but I haven't gotten into really the timing. We actually do the value calculations, tax rate calculations, and tax calculations for each parcel twice a year. We go through the calculation process with proposed information first. And in Minnesota, this is known as truth in taxation. We're actually in that time frame right now, kind of winding down to the end of it. So taxing authorities certify proposed levies to the county by September 15th. Schools have a little bit later date. We calculate rates and taxes based on the proposed levies, and we then mail a notice of proposed taxes to taxpayers between November 10th and 24th. We include the date and location of budget meetings along with the tax amounts, and local units of government are able to include an insert to provide additional information if they desire. Taxing authorities hold budget meetings on proposed taxes between November 26th and December 26th. And then after receiving public input, taxing authorities set their final levies and certify to the county by December 28th. Now, I should note that although values are printed on the truth in taxation or proposed tax notice, that meeting is not the place for taxpayers to object to their values. The place to do that is during the appeal process that Bruce spoke about, because values are considered final on July 1st. Well, it's actually during like April, May. Yeah, that's really the time. And that is the problem, is that sometimes when they get the value notice, it doesn't mean a lot to the taxpayer. It's when they get something that actually has a dollar amount due that comes to the forefront.
We get most of our commercial appeals in November. They don't call in the spring, they call.
Yeah.
The mortgage company bases, if they keep your property taxes with your mortgage payment, they'll use these numbers to change their until a person contests it or gets awarded that.
Okay, so then final levies are due December 28th. We then repeat the tax rate and tax calculation process using the final levies. Would also include special assessments on the tax statement. We mail the tax statement by March 31st, and we do mail it along with the value notice then for the following year. So essentially, the taxpayer will get prior year and current year information on the tax statement, and then they'll get the following year's information, actually current year and the next year's values on the value notice. So they'll basically get 3 years of values between those two notices. So just this next slide just summarizes the timing and correlation of those 3 major parcel-specific mailings that we send out each year. The value notice would be mailed in March of year 1, let's call it, which has the value on January 2nd of year 1 for taxes payable in year 2. Then we'll go further throughout the year, get into the proposed process, In November of year 1, we'll send out the taxes that would be due in year 2 if the tax authorities approve the levies that they are considering. Then everything gets finalized, and finally, in March of year 2, we will send out the actual tax statement that has the taxes due in year 2. So hopefully that makes sense. As far as due dates, first half property taxes are due May 15th, and second half is due October 15th. Unless the property is agricultural, then the second half is due November 15th. Or manufactured homes are due August 31st and November 15th.
Why are manufactured homes treated differently?
Manufactured homes are actually an exception. They're assessed and payable in the same year, so they don't have the same 2-year cycle. They only have a 1-year cycle. So we actually mail those. We need a little bit longer time to send those out. So those aren't mailed until roughly June. So they have a longer time frame, especially for the first half.
So why treat them differently? Do you know where it came from?
Because they're so easily moved, it's hard enough to track them. You can maybe address that. You know, it's hard enough to track them from year to year, but if you had a 2-year lag, it would be really hard to track them. So that's the main reason. So what happens if taxes aren't paid on time? We do send out reminder letters after the first half, second half due dates to let people know. Penalty does begin to accrue the day after the due date, and the rate increases monthly throughout the year. At the end of the year, the final rate would be 10% for homestead property and 14% for non-homestead property. So that can add up. And also in January of the following year, interest accrues in addition to and on top of the unpaid tax and penalty. The current interest rate is 10% per year, and it's calculated on a monthly basis. We do collect taxes on behalf of all local taxing authorities in the state, and then we periodically distribute the monies back to the tax authorities who levied them through the settlement process. Is what we call it. The 3 main dates that we do this are July 5th, December 1st, and January 25th. And to the previous question, we distribute only what was collected, and it may not be the full levy. Some of the reasons for the difference would be tax delinquencies. There may be abatements or additions of tax, or there may be tax court ordered changes. Generally, though, we find that collection rates in the county are pretty high. We average over 98% collected in the year of the levy. Obviously, that will vary from jurisdiction to jurisdiction, but that's an average. And just for informational purposes, for 2012, our total billing was, including special assessments, was $382.1 million. So that's what happens when taxes are paid. What happens to taxpayers who don't pay their property taxes? At the beginning of each year, we go through a process to identify newly delinquent parcels. And that process consists of mailing a letter to each affected taxpayer. We'll also publish it in the newspaper, and we'll also file a judgment with the court to get a court judgment against the parcel. Basically, what happens then is there's either a 3-year or a 5-year redemption period. It's 3 years if it's non-homestead or in a city, 5 years if it's homestead or in a township. So if the taxes aren't paid within that 3 to 5 year redemption period, the property will forfeit to the state of Minnesota. And then the county manages any tax forfeited parcels on behalf of the state. Now, that 3 or 5 year period counts from the year following the first year of delinquency. So a parcel that has delinquent 2012 taxes, you will start counting that 3 or 5 year period from 2013. So really it ends up being 4 to 6 years from the year that delinquency was for.
Somebody takes the market value of the
valuation tax credit, is that, is it going to stop the tax collection until that decision is made? Any interest that would accrue on that?
You have to have your taxes paid in order to process the petition.
Oh, so they still have to pay them even if they're disputing the market value? Oh, okay.
So you get those dismissed, but they still may not pay their taxes.
Okay, thanks.
There are a couple of state property tax refund programs to assist taxpayers. There's the regular property tax refund, which applies to homestead property. It's based on income and property tax due, so there are some income limits, so not everyone would qualify for that. There is also a special property tax refund, which also is just for residential homestead property, for property owners whose taxes increased more than 12% and the increase was over $100. The refund would be 60% of the increase over 12% for a maximum of $1,000. There are no income requirements for that. So that would be a case in which if someone chose not to homestead their property, they would make themselves ineligible to receive that refund, should they even qualify for it. And then there's also a senior citizen deferral program, which is another state program which assists taxpayers who may have difficulty paying taxes. It allows taxpayers 65 or older with income of $60,000 or less to defer a portion of the property taxes on their home. Basically, it limits property taxes to 3% of the household income. And this is, it's a loan, it's not a tax forgiveness program. And the way it works is that the state will pay the deferred tax to the county and basically loan it to the taxpayer for an interest rate not to exceed 5%. There is a lien on the property, and then when the property no longer qualifies or is sold, that loan is due within 90 days. We do not, roughly a dozen or less. Okay, so far we've seen that property taxes are pretty complex with a lot of moving parts. We sometimes see that folks have, there are some common myths or misconceptions about property taxes that we hear a lot, and thought it might be helpful to go over some of the most common ones. So the first one is your value for property tax purposes should be significantly below what the property would sell for. And as Bruce said, we're required to be between 90 and 105%. The county goal is 95%. So actually, we're required to be at market value. The next one, if property values go up, the county, city, and other governments get more money. And for that one, value does not create the tax burden, it only distributes it. I think Bruce used those exact words. The only way taxing districts get more money is by increasing the levy. Value increases by themselves don't increase the total amount of taxes raised, although they can raise taxes on individual parcels. And conversely, if property values go down, the county, city, and other governments get less money. Again, value does not create the tax burden, it only distributes it. The only way taxing districts get less money is by decreasing the levy. And this is probably one of the more common ones. My value went down, so my taxes should go down. And the answer to that one is that value reductions don't necessarily lead to tax reductions. It depends on levy changes and how the value change on a parcel compared to other parcels. If all parcels had the same value reduction and the levy didn't change, then there might be no change in tax. So that kind of leads into more on what are the reasons for tax change, why are the reasons the taxes change on a parcel from year to year? And it can be for a number of reasons. You know, as we saw, value exclusions, varying percentages of market value based on classification, multiple tax bases, can cause taxes to shift between parcels. But then when we get to taxes, there's also a change in taxing district levies. Could be a change in the parcel's classification, change in the parcel's value. How does the value change on a parcel compare to the value change on other parcels? Did it go up or down more or less than average? Or the change in the tax base value of a taxing district? And then with the homestead value exclusion increasing as the value decreases or decreasing as the value increases. And then, of course, there could be law changes, such as changes in class rates. So just to give you an idea of how only one variable can affect property tax changes, this example assumes a city with 4 parcels, all homestead, with a levy of $10,000. I have a scenario 1, which is a baseline. It assumes no change in value from the prior year and no change in levy. So I've got some charts off to the side that show what percentage each parcel pays of the total tax, and then showing percentage change in market value in tax. Since there's no change, there's nothing to graph there. But basically you have a $100,000 home, a $200,000 home, a $250,000 home, and a $450,000 home. I don't know, Bruce can tell me from my drawings if I hit the values there. Not so sure on that. But okay, now I've got a scenario 2 where I assume the value on all parcels go down 10%. So if you look, the percentage change and estimated market value on all parcels is a uniform 10% reduction. So you might expect that the tax change on all parcels would be uniform? Is that what people would expect? But if you look at it, it's not. On the graph at the right, the blue is the percentage change in market value, so that's all uniform. The red bars are the percentage change in tax. And the $100,000 home that's now valued at $90,000 has a 4.4% tax reduction, while the $450,000 home that's now valued at $405,000 that has the same 10% value reduction actually has a 1.3% increase in tax. And that's because we calculate everything from scratch, so to speak, each year starting with values. You know, we don't do a percentage up or down on each parcel so that every parcel has a uniform tax percentage change. I have a scenario 3 then that assumes values on all parcels go up 10%. So again, the percentage change in market value on all parcels is a uniform 10% increase. And in this case, the result is the opposite. In this case, the lowest value home has the largest increase, and this time the higher value home has a slight reduction. And then a 4th scenario, which is the most realistic, assumes some parcels go up in value, some go down, and then I have one, the $450,000 parcel, staying the same. And as you can imagine, the changes are kind of all over the place here. So this is just by changing one variable, how it changes the mix and shifts taxes between parcels. If you add to that the value exclusions, the classification changes that can change the percentage of market value that's taxed, the multiple tax bases, programs like tax increment financing and fiscal disparities, which can redistribute the tax base, and also add to that any levy changes that occur, that can make it really difficult to explain to a taxpayer why their taxes did what they did. So in summary, Minnesota's tax system in theory. In theory, the tax system is quite simple. Tax dollars equals base times rate. But in practice, we have to make a few modifications to make the system fair. I didn't come up with this graphic. It's been around for a few years, but I think it's a great representation of the complexity of Minnesota's tax system. And actually, because of that complexity, in 2010, the legislature established a property tax working group. Their goal is to examine ways to simplify and improve the state's property tax system. They have a report due to the legislature in February of 2013. I don't know if anything will come of any of the recommendations, but if you're interested in seeing what they came up with, we've included the URL to the report here. And then just for the final part of my presentation, I just have a few slides with some Washington County specific information. Just this chart shows the blue bar is estimated market value, the red bar is taxable market value, and then the green line is the tax capacity that's used to calculate the local tax rate. So that would be the value after all adjustments that we talked about. So as you can see, we hit the high point in 2009, and values have been declining since there. Since then, we're roughly currently at about the same level as we were in 2005, 2006. This chart shows, if you think of the pie as representing all estimated market value of all taxable property, the blue part of the pie represents the taxable market value, and then the colored slices represent value that is excluded from taxation. So really, the blue pie, so to speak, has to expand to cover what's not being taxed by the parcels in those programs.
Question, how do we compare to other states in terms of some of these exclusions?
You know, I really don't have that answer. I'm not sure if the Property Tax Working Group, they have some materials that were presented, and I know there was some comparison. I'm not sure if they got into exclusions, and not sure to what extent many states have those types of things. Okay. This chart shows estimated market value, taxable market value, tax capacity, and tax paid by major property classification. So for example, residential is, which is the bright blue or aqua, is 70% of the estimated market value. It makes up 69% of the taxable market value, 60% of the tax capacity, and pays 55% of the total tax. If you look at commercial, it's commercial, industrial, and utility, I should say. It's 14% of the estimated market value. It doesn't have exclusions, so it's 15% of the taxable market value. It has higher class rates, so it makes up 25% of the tax capacity, and it pays 33% of the total tax. So this is really where you can see the combined impact that exclusions, class rates, tax bases can result in different or increased taxes being paid by certain classifications. And then the last one on Washington County, the distribution of the tax dollar. Where does each tax dollar go? This is a county-wide total, so it'll vary between jurisdictions, but on average, 23 cents to the county, 27 cents to the city or town, 34.5 cents to schools, 9 cents to the state, 2 cents to TIF districts, and other districts get 4.5 cents. This is a graphic that I found in the report from the Property Tax Working Group that I thought might be helpful. It's just a good summary of the timeline that we've discussed. Might be helpful to see it laid out in chronological order. Basically I guess it's brown on the top, shows the value establishment and review process timeline that Bruce discussed. Then there's a blue section that kind of shows the timeline for the local budgeting and truth and taxation process. Then it moves into green with the actual tax statement billing process, and then moving into the delinquency process. So just seeing the process in chronological order there. I did want to mention that we do all of our communication with taxing districts via our website. We really don't mail anything. So we have a section of the property tax website devoted to property tax administrators. So if you go to www.co.washington.mn.us, there'd be a link on the front page for property and taxation. And then from there, you can select property tax. And then property tax administrators, we have levy certification forms, information on values, information on tax rates, and other property tax information there. And I do want to mention, I know that taxing districts may want to consider the impact to taxpayers of levy amounts that they're considering, and all of the formulas and calculations that we went through tonight might seem a bit intimidating to try to attempt. So we do provide a spreadsheet that has all, we call it a tax impact worksheet. It has all of the formulas built in, and you just enter a levy amount and select the value of homes to calculate for, and it'll help you with those calculations. We generally update that several times during the year as information becomes available. So that's something you'd find under the tax impacts section. And we also do have some links on there that are links to other websites that have some good property tax information. Other than that, any questions? Yes?
Can you tell me how this session presentation differs from the one that the county requires for local board of review members? And would you consider this being that requirement?
This does not meet that requirement.
What's the difference?
A lot of the information we covered tonight would be in that presentation, but it's more focused on your role as a local board or county board in the appeals process. Yeah. We just had...
I'm not sure that, we don't have the authority to grant you that, but the Department of Revenue requires that training.
That's state statute.
Yeah, maybe we could talk to them and see if there could be some kind of a credit given for this or not, but it's certainly not something we can grant on our own.
It's the county that puts the training on, right?
Well, the Department of Revenue puts it on. We held it.
Oh, you sponsor it?
Well, we held it here, what was it? Help me out. Recently.
I was there, I don't know what it was though.
Yeah.
It was still pretty warm up.
Are you newly elected?
No.
No? They have training for newly elected officials coming up in March.
Right.
So what we do when that information becomes available, we send that out to all the clerks.
Yep. Okay. I'm
Okay.
aware of it. I just haven't gone through it, and I'm not on the board review,
Okay.
but I might be at some point. So as long as I'm here, I wanted to ask if that.
Okay.
Any other tax questions? Yes.
As I'm just a local representative, and I'm pretty interested in how the county determines its tax rate, how the county tax sets its tax rate as to how much it receives it must collect, and how that.
Well, basically, it would be the same process that we discussed. The county would determine a levy amount. So is that the question, how it determines that levy amount?
County goes through almost a full year budget cycle, so we started probably in May with a workshop at the county board where we got direction from them as to guidelines that they might want us to look at. So there's things like making sure we use technology effectively. It might be something about, levy increases beyond the rate of population growth. It's looking at programs that may no longer be effective or as valuable. So they set those policy directions, and then we ask our department heads to go back and take those guidelines and directions from the county board and develop a proposed budget. And usually in that workshop with the county commissioners, we get a sense as to
if they will support a property tax increase and maybe what percent. And as part of that, we might lay out, okay, if we have settlements with our labor unions, it looks like it would cost us this much. We might say if we've got some other known liabilities or we know we might issue bonds. So we would lay that out for commissioners and they would say, well, we want to do this, we don't want to do that. We don't want to raise the levy, and so that would mean if there's additional things they might want to take on, that we would be cutting other programs. The departments take about 2 months to propose their budget. They submit it to administration. We take about a month and a half to review it and get it down to something that we think is, viable with the county board. We usually present our budget to the board the first week of August, and then each department will do a presentation over the next month to the county board laying out how they specifically will use the dollars that are being allocated to them. The county board then will set the preliminary levy in mid-September. We may have more workshops with the board on the budget if there are questions raised that might need further research. Then we'll hold the public budget meeting required by law in December. And actually the county board for this year voted on Tuesday to approve the levy that will go into effect next year. And then starting next May, we'll start the cycle all over again. And during the years that we've had some reductions mid-year from the state, we've actually usually gone through that process twice in 1 year to try to manage the reductions. Right. Right. Yeah. Well, certainly all of our workshops are public, so we post them on our website. We put them on the agendas that go out. We've had in the past sort of budget open houses. We actually haven't done that for the last 2 years because we put a lot of time and energy into it, and usually we would get less than half a dozen people, and most of them were actually former employees who were just coming back to hear how the organization was doing. So we've put a lot of information out on our website, and we televise all the departmental budget meetings that are made to the county board, and we'd certainly be open to advice as to how we get the information out to citizens. I will say that we often sort of have the other side of it. It's interesting to me that usually at our Truth in Taxation meetings, the people that come tend to be from communities that have had high tax increases. And they come in and say, well, but you're the higher level of government. Don't you have the authority to tell that city or township what to do about their taxes? And we get into the same kind of thing, not wanting to pass the buck, but to say that we don't have that authority. So, yeah.
Bruce, I probably beat the dead horse, but city property tax refund program, your circuit breaker or your special property tax refund clause, this is all something to be discussed in the April, July discussion. This isn't something that we can introduce to our local assessor now and have input. For example, if someone comes up and asks me about this property tax increase, because we have had some increases, and in this, if it goes up more than 12% and it's over $100, is this something that can happen this year, or is it something they're going to discuss in April and then do it for the following year?
Talking about the tax refund.
Yes, the property tax refund, that applies to tax dollars, not value.
Okay, that's the dollar.
Yes. Yeah, so that would be after receiving the tax statement.
Okay.
But Joanne, if the tax statement goes out in March of 2013, the property tax payer has a significant increase, when do they have to file that refund by? Like August?
August. Yeah, August, something.
That was my question.
Yes.
By August.
So last August was the time to do it for this. time a person should.
So their 2012 taxes
Well-
were high, had a large increase, and they still filed for a refund of their 2012 tax.
You know,
Penalty though, if you file an amended return.
Not an income tax, though. It's not
No,
an
on
income-
your property tax
property tax.
return. They used to
Yeah.
have a penalty clause
yeah,
where it would be reduced by 25% or something.
yeah, I don't have that
Maybe
answer.
the payment side of it, yes, right, that'd be the retroactive part, but I mean, this current year,
Well, it would be due the August following the year when the tax statement came out. Yeah, so they do give you time to do that.
So the statement was sent in March, they filed by August of next year.
Yes. Okay, well, if there are no other questions,